Hey, real quick, before you skip this video, I want you to meet someone. His name is David, 67 years old, retired teacher from Ohio, spent 35 years of his life working, saving every single dollar he could into his retirement accounts. Did everything right, never missed a contribution. And last year, when he finally sat down with his accountant to figure out his retirement income, he found out he owed over $14,000 more in taxes than he expected. Not because he did anything wrong, not because he cheated the system, but because the rules around how his retirement accounts are taxed had quietly changed, and nobody told him. Nobody sent him a letter, nobody called. The government just updated the rules. And David, like millions of other seniors right now, had no idea. So if you have a 401k, an IRA, a Roth, a pension, or any kind of retirement savings, you need to watch this entire video. Because what you don't know about these 5 accounts right now could cost you thousands of dollars. And I'm not saying that to scare you. I'm saying it because David's story is not rare. It's happening every single day to people who saved responsibly their whole lives and still got blindsided at the worst possible time. So let's talk about it. Let's actually break this down in plain English. No financial jargon, no confusing tax code numbers thrown at you, just the real stuff you need to know so you can protect what you've worked your entire life to build. The first account we need to talk about is the traditional IRA, and this one is catching a lot of people off guard right now. Here's what most people understood for years. You put money in pre-tax, it grows tax deferred, and when you pull it out in retirement, you pay income tax on it. Simple enough, right? The problem is what's changed around required minimum distributions, or RMDs. For a long time, you had to start taking money out of your traditional IRA at age 70 and a half. Then it moved to 72. And now, thanks to legislation that took effect recently, that age has moved again to 73. And it's scheduled to move to 75 by 2033. Now you might be thinking, great, more time to let my money grow. And yes, that part is true. But here's what people are missing. When you do eventually start taking those distributions, if your balance has grown significantly over those extra years, your RMDs are going to be larger. And larger RMDs mean more taxable income in a single year. More taxable income could push you into a higher tax bracket. It could trigger higher Medicare premiums. It could even affect how much of your Social Security gets taxed. It's a chain reaction that a lot of people aren't seeing coming because they're only focused on the delay and not what happens after the delay. So if you have a traditional IRA and you're in your late 50s or early 60s right now, this is the exact time to start thinking about whether it makes sense to do some strategic conversions before those RMDs hit. Because once you're forced to take the money out, you lose control over the timing. And in taxes, timing is almost everything. Now let's talk about the 401k, which is probably the most common retirement account in America. And the changes here are actually a mix of good news and something you really need to pay attention to. The good news first, contribution limits have been going up. And there's something called catch-up contributions that were already in place for people 50 and older, allowing you to put in extra money beyond the standard limit. But here's where it gets interesting and honestly a little complicated. For people who are between the ages of 60 and 63 specifically, there's now a higher catch-up contribution limit available. That's a meaningful opportunity if you're in that window right now and you're still working. You can sock away more money than ever before. But, and this is important, there's a new rule tied to catch-up contributions for high earners. If you make above a certain income threshold, your catch-up contributions now have to go into a Roth 401k rather than a traditional pre-tax 401k. That means instead of getting the tax deduction now, you're paying taxes on that money now and getting the tax-free growth later. For some people, that's actually a better deal long-term. But for others, especially those expecting to be in a lower tax bracket in retirement, that forced Roth treatment could cost them more upfront than they want to pay. The key thing to understand is this: your 401k is no longer a one-size-fits-all bucket. The rules around how your money goes in and comes out have gotten more specific, and if you're not paying attention to those specifics, you could be making contribution decisions that aren't actually optimized for your situation. Here's something I want to pause on for a second because I think it's really important. A lot of people think about retirement accounts as this thing you just set up once, point money at, and forget about until you retire. And that worked fine for a long time. But the tax environment around these accounts has been shifting, and it's going to keep shifting. The people who are going to come out ahead are the ones who are actively engaged with where their money is sitting and how it's going to be taxed when they need it. That's not about being a financial genius. It's just about staying informed, which is exactly why you're watching this video, so you're already ahead of most people. Moving on to Roth IRAs, and this one is a bit different because the changes here are mostly in your favor, but there's a catch that a lot of people miss. Roth IRAs are funded with after-tax dollars, which means when you pull the money out in retirement, it's completely tax-free, no income tax. And unlike traditional IRAs, Roth IRAs don't have required minimum distributions during your lifetime. That means you can let the money sit and grow as long as you want. Now, recently, those rules got extended. Roth 401ks, which previously did have RMDs, have now been aligned with Roth IRAs, meaning no RMDs required during the owner's lifetime. That's a significant change. It gives Roth accounts even more power as long-term tax-free growth vehicles. But here's the catch I mentioned. When you pass your Roth IRA onto your heirs, the rules have changed significantly. Under the old rules, beneficiaries could stretch distributions over their lifetime, letting the tax-free growth continue for decades. Under current rules, most non-spouse beneficiaries now have to drain the account within 10 years of inheriting it. And while the withdrawals are still tax-free, the compressed timeline means your heirs have less flexibility in how they manage the inheritance. So, if part of your retirement strategy involves leaving wealth to your children or grandchildren, you need to factor this into your planning. The Roth is still one of the most powerful tools available to you, but the way it works as a legacy account has fundamentally changed, and your estate plan probably needs to reflect that. Now, let's get into pensions, because even though fewer people have them these days, there are still millions of retirees receiving pension income. And there's a critical misunderstanding that's costing people real money. Many people assume that because their pension feels like a steady paycheck, it must be taxed the same way a paycheck is. And in some ways, yes, pension income is generally taxable at the federal level. But here's what trips people up. The state-level taxation of pension income varies wildly. Some states don't tax pension income at all, others tax it fully. And some states have exemptions that depend on your age, your income level, or the type of pension you have, whether it's from a private employer, a government job, or military service. And these state rules have been changing. Several states have recently modified or expanded their pension income exclusions, meaning some retirees are now paying less state tax on their pension than they were just a few years ago. But you only benefit from that if you know about it and actually claim it. This is one of those situations where the money is sitting there waiting to be saved, but it requires you to be proactive. If you're receiving a pension and you haven't had a detailed conversation with a tax professional specifically about how your state treats that income, you could be overpaying and not even know it. And if you're thinking about relocating in retirement, which a lot of people do, the state tax treatment of your pension income should absolutely be one of the factors you consider when picking where to land. The fifth account is one that doesn't get talked about enough, the health savings account, or HSA. Now, technically, the HSA is a health account, not a retirement account. But for people who use it strategically, it functions like one of the most powerful tax-advantaged vehicles available. Here's why. Contributions go in pre-tax, the money grows tax-free. And if you use it for qualified medical expenses, withdrawals are completely tax-free. That's a triple tax advantage that no other account offers. And here's the retirement angle. After age 65, you can withdraw money from your HSA for any reason, not just medical expenses. If you use it for non-medical expenses after 65, you'll pay income tax on it, same as a traditional IRA, but you'll never pay a penalty. So in the worst case, it behaves exactly like a traditional IRA. In the best case, if you're using it for healthcare costs, which, let's be honest, most people in retirement have plenty of, it's completely tax-free. Now, what's changed recently is that the contribution limits have been increasing, and there's been more flexibility added around what counts as a qualified medical expense. But here's the catch. You can only contribute to an HSA if you're enrolled in a high-deductible health insurance plan. And once you enroll in Medicare, you can no longer contribute. So the window to maximize your HSA is typically during your late working years, before Medicare kicks in. If you're in your 50s or early 60s right now and you have access to an HSA, the strategic move is to contribute as much as you possibly can, pay your current medical bills out of pocket if you're able to, and let that HSA balance grow untouched. Then, in retirement, you have this tax-free reserve sitting there, specifically for the healthcare costs that are almost guaranteed to hit you. Here's the big picture that I really want you to take away from all of this. Retirement tax planning is not a one-time event. It's not something you figure out at 65 and then you're done. The rules change, the thresholds change, your income changes, your health situation changes, and the tax code, whether we like it or not, is always evolving. The people who get hurt aren't the ones who made bad investments. They're the ones who got set it and forget it with their retirement accounts and never revisited whether the strategy that made sense when they were 45 still makes sense when they're 65. David from Ohio, the retired teacher I told you about at the start, he wasn't financially irresponsible. He just never went back and looked at the new rules. And a $14,000 tax bill in your first year of retirement when you're on a fixed income is devastating, not just financially, but emotionally. You worked your whole life for that money. The least you deserve is to keep as much of it as the law allows. So here's what I want you to do right now. If you have any of these 5 accounts, whether it's a traditional IRA, a 401k, a Roth, a pension, or an HSA, take this video as your reminder to schedule a conversation with a qualified tax professional or financial advisor who specifically understands retirement income planning. Not just a general accountant, someone who knows the current rules around these specific accounts, because the rules we talked about today are already in effect. They're not coming, they're here. And the sooner you get your strategy aligned with the current tax environment, the better position you'll be. And if you found this video helpful, and I genuinely hope you did, please hit that like button right now. It sounds simple, but it actually makes a huge difference in helping this information reach more people like David who need it. Subscribe if you haven't already, because we cover this kind of stuff regularly. Real practical financial information for real people who are trying to protect what they've earned. And drop a comment below and tell me which of these 5 accounts you have, or if there's a specific retirement tax question you want me to cover in a future video. I read every single comment, and your questions genuinely shape what I make next. Thank you so much for watching. I'll see you in the next one.